Welcome back to the channel. My name is Brad, and today we're going to cover one of my favorite high income ETFs, FEPI. I've been an investor in FEPI almost from the beginning. Truly enjoy those high distributions every single month. So what is FEPI? FEPI owns big tech. They own 15 different companies, and they write cover calls against those companies. One thing I liked about FEPI is they stagger their calls. Very much like QQQI and NEOS, they stagger their calls, same expiration date, but different strike prices. This allows us to receive income and not cap or potentially cap our appreciation. I really like how they stagger those. So how does FEPI pick their 15 stocks? It's actually an index. Selective FANG Innovation Index. Been around for years, but this is how they actually pick these 15 stocks that they hold, and they actually hold them. These are not synthetics. They actually own the underlying stocks. Right now, they're claiming a 25% distribution. It's been slightly lower than that lately, but it's been very close to that 25%. It's been greater than $1 per month per share, which is very nice. I like to go out to Portfolio Visualizer and see how this is done. Let's see what the income has been for this ETF year to date. We're going to compare it to JEBQ and QQI. So far, it's paid $6,551, where QQQI has paid $3,818. With JEBQ, I'm not even going to talk about it. For annual returns, FEPI has been down a little bit. There's a reason why, and if you continue on to the end of the video, I'm actually going to look at all 15 stocks and their health financially. And there's one in particular that drew down FEPI, 6% in one single day. As you can see, QQQI is greater at 10.39, but stay around to the end of the video and we'll look at the health of these underlying stocks that they own. The price chart since October is telling me they're relatively flat. FANG has been down. Innovation has been hampered a little bit. But if you believe in the 15 stocks, and I'm going to say, hey, I believe in 13 of them strongly, then this is a good investment for you. Every month they pay regular distributions, and so far they've always been more than $1. Who doesn't like $1 per share? The number one reason FEPI is down right now is Intel. On August 2nd, Intel brought FEPI down 6.29%, and that's even before the Japan carry trade. That's a big percentage to drop. Intel, over the last few years, have been trying to reinvent themselves. They fell behind Metcalfe's law of innovation. The chips became not as good or as quick as AMD. They weren't innovating as fast as AMD. If you know anything about Intel, Intel's been building multiple factories to increase their production of chips and also have set new targets for innovation. It may take some time for Intel to turn it around, but as one of the big chip makers in the world, Intel will eventually turn itself around and be very profitable again. Have faith in it, but this is what is bringing down FEPI. I appreciate you watching this video. If you like it, please give it a thumbs up. Hit the subscribe button and put a comment below. And on to the video. When I look at AMD, AMD has very good cash equivalents. Their free cash flow is down a little bit in 2023, but they're innovating. NVIDIA, look at that free cash flow. 2023 was a monster for them. If you believe in AI, Nvidia is a must-hold stock, or better yet, hold it in a high-income ETF that pays you 25% per month. Amazon, with their Amazon Prime, you can now see that they, in 2023, are turning a profit. They have free cash flow. Their debt is still a little bit high, but they'll be able to pay that debt down with free cash flow. Apple, I have Apple. Who doesn't have Apple? Some people, but there's a majority of people that use Apple products. From the Mac to the iPad to the iPhone, they are one of the major players in the cell phone industry. A lot of people wouldn't be able to function without their Apple. Google, with their cash flow greater than their debt, is another good innovation company. They're coming out with AI. They have lots of services. Who doesn't Google the answer to their quizzes and tests? I know I did a lot of that during my college days. Broadcom, they have a lot of debt, but they have good free cash flow. They also are innovating. There's a lot of Broadcom chips and a lot of different other products that are out there, especially for the AI. Adobe, with their subscription plans, is generating pretty good revenues. Their debt is low, their free cash flow is high, and their cash equivalence is also high. What's there not to really love about Adobe, except everybody's expecting them to continue this, and it's something that we need to watch. Microsoft, one of the big players in innovation. A lot of companies use Microsoft today for their software. They're not going to go anywhere in the next few years. They have good free cash flow. I would love to see them to pay down some of their debt though. Meta, I don't know if you use large language models, but they're publishing theirs out there for free. They are definitely in the AI world and they're innovating. Glad to see Meta's part of the group. Netflix, I'm glad to see that they're still around. I thought they were going to go out of business. Who is going to stream movies online? Oh, wait a second. I do every night. Holy cow. Maybe it's something we should own. Free cash flow's good. Again, wish they would pay down some of their debt, but okay. 2023 wasn't the best for free cash flow. They did some innovations, but so far this year, they've been hitting their quarterly earnings, which is a good sign. Palo Alto, not so great in that free cash flow, but they're going to turn things around in 2024. CRM, or Salesforce. If you're in sales, you know what Salesforce is and the driver that all these big companies are going to with Salesforce. Looking at their free cash flow, looks healthy. Debt is coming down. Cash equivalence is going up. What's there not to like about Salesforce? And last and not least, Tesla. Clearly, their margins are doing well. They went from negative margins to positive margins. Would love to see the margin rate slightly over 18%. But okay, I'm not going to be too picky on that. But they are definitely starting to show a net income. China is the biggest culprit of what's holding them back. The competition in China is much stronger than the competition here in the United States. But hey, Tesla is out there innovating. If I look at the financial health of Tesla, wow, I see really good charts. Debt has come down a little bit over the years. We have good free cash flow, and cash and equivalents are awful high. Is FEPI right for you? I know FEPI is right for me. I think as somebody that's looking for some high yield off of innovation and FANG, this is the ETF to go to. I think some of the other ETFs that are out there are setting their strike prices either too high or too low, or they're writing their calls too often. I think FEPI takes a balanced approach. I think FEPI, with how they stagger their strike prices, is correct methodology for earning income. Time will tell, but looking at the market, always rising to the right, I think we've had price corrections. I think earning 25% during price corrections is a good deal. I think that if you're reinvesting at least some portion, I reinvest 20%. Is that the right number? I don't know. I think it is. I don't think it's 10. I don't think it's 30. I think it's right around that sweet spot of 20%. I think FEPI, in the long run, will continue to produce 25%. Price will continue to go up, or will continue to fight to go up. And we can expect that $1 per share every single month and enjoy the income. Well, thank you for watching. Until next time, God bless.